Join my Telegram for free investing tips. Beginner investors lost money because they kept making the same mistakes over and over again. So how do we avoid the mistakes, and what are they? In this video, I'll show you 8 biggest investing mistakes beginners make so you can avoid them and become a smarter investor. Mistake 1. Following the crowd. One day you woke up and you were on Reddit scrolling through Wall Street bets, reading and hunting through posts, looking for the next king in the making. And you found one, a stock that is very unique that maybe says creates electricity from oxygen, and you bought into that stock thinking that is a hidden gem with untapped opportunities. And all into this stock thinking it is going to fly to the moon, but found out it slumped all the way down. And that is mistake 1. Following the crowd blindly. Mistake 2. Buying a company you don't understand. For example, you bought iPhone and then MacBook, AirPods, and you loved Apple products and realized the whole ecosystem is the business model and bought stocks of it because you understood the company well. I knew the products well. I understood the company well too, which led me to making money from Apple's stock investment. But what if you don't know the company well and you trusted a guy on Reddit, Wall Street Bets, and bought into a company that makes electricity from air or any materials or well, you get the idea. And then this happens. Mistake 3. Ignoring all of the financials. Many beginners spend hours only looking at the stock charts and ignoring financial statements, which doesn't make sense to me. For example, Warren Buffett once said, "Accounting is the language of business." If you don't understand accounting, it is very difficult to understand a business. And if you don't understand a business, how can you confidently invest in it? Which we can imagine Warren Buffett in his young days reading through every business financials before deciding to buy into the stock. Some simple financials to focus on would be revenue and net income, and make sure they are consistent or consistently increasing, which is why accounting is the language of business and is very important to understand. Mistake 4. Buying a stock just because it is cheap. Today, you are looking at the stock market and hunting for some gems. And you found some stocks, but not sure if they're gems, but the pricing of the stocks are very cheap. And you bought into all of them and praying that they will go to moon like Bitcoin in 2025. For example, Under Armour, UA, the revenue and net income is inconsistent with both decreasing consistently, which tells us why reading the financials is important, else it will be like mistake 5, not diversifying your portfolio. Ray Dalio, famous fund manager, once said the holy grail of investing is finding 15 or more good uncorrelated return streams. But what does it mean? It means to have 15 stocks that are not related to each other to diversify your portfolio, preventing over-leverage. For example, we can see Ray Dalio's portfolio that is valued at $27 billion with 973 stocks in total. Very shocking indeed, but for us, we can aim to have 15 to 20 stocks as bare minimum. Mistake 6. Trying to time the market. For example, Apple stock. It was at support level of 246. But you waited and then it went up to 275, and then you waited again and now it went up to 300, and you missed the opportunity when it was at 246. And like the usual phrasing that says nobody would know when is the bottom, so buy in at support levels and average down is the best method. Mistake 7. Letting emotions control your decisions. For example, your portfolio is up 27% and you are happy on cloud jumping left and right, and you bought more shares. But then a black swan happened and your portfolio is now down 20%. And you sold all of the shares off, but days later, it rebounded back. Which is why we must not let emotions control our decisions. For example, I bought Meta back in 2021 at 381 at the peak, and it dropped to 87, but I hold on to it. Why? Because it is a very good business, which will increase in value over time, but this strategy will only work for good business. Mistake 8. Expecting to get rich overnight. For example, you bought into Apple stock, expecting to get rich overnight. But the truth is, wealth is compounded over the years with relying on the law of compounding. Warren Buffett once said, "Life is like a snowball. The important thing is finding wet snow and a really long hill." What does that mean? Imagine snowball equals money. The wet snow is finding great businesses that continue growing over time, and the long hill is tying it first. The snowball barely grows. But the longer it keeps rolling, the bigger it becomes. Investing works exactly the same way. Find great companies, give them enough time, and let compounding do the rest. For example, Warren Buffett's wealth journey from age 11 to age 95, it took him 84 years to get from 114 to 160 billion, which shows us that even the legendary investor relied on the law of compounding, and was it through overnight investing. And that is the end of our 8 investing mistakes made by beginners.